I was looking for my body. Where's the bag? I went in my car looking for it. I forgot it. Where's it? It's not mine.
I think that's ours. Like, I think that's
I didn't even go to home. I was on my own.
sitting on your desk.
Crazy.
Now we're getting fancy.
Literally on my own every time.
Yeah, that's ours.
Oh, okay. We couldn't find me.
I did. I thought I put one on your desk the other day. It's here. It's here.
Things. I'm stopping by and they walk, Exactly. I was just telling Cameron that we've been leaving him in the spirit this year, or I guess it's carnival season. And there are a lot of actually a lot of artists.
Cameron, where's yours? Do you have the
Yes. So on Causeway, if you know the Crescent Title building on Causeway, we're on the second floor. Yeah. There every day of my life. So including Saturday and Sunday. Don't tell my wife.
Holiday all the time, but I just set for her. She's kind of took the New Orleans, and saying that was a lot of traditional jazz. I played brassband music. Awesome.
All right, well, y'all, we're going to go ahead and get rolling.
Yeah.
Before we start, so I learned this yoga pose over the holidays. I know we're a month removed, but I want everybody to try it. Just puts you in the right mood, gets everything set up, okay? So what I want y'all to do, it's easy, you can do it from your seat. Put your fists together, not too tight, that ruins the whole purpose of it. Fists together, up and down, arms up, turn your wrist down, and throw your thumbs up. Now hold that for 1 second, let's get a quick photo. Y'all did a great job. Get everybody in there? Yeah, awesome, y'all look great. So for those of y'all who don't know me, Cameron Budges, I run the mortgage firm. Are also in Metairie on Causeway, but we're here, obviously. What we're gonna go through is kind of what we expect in the mortgage market through the year. We'll touch on housing, and I want y'all's input on this, okay? So before we really jump into that, first, if you don't have my contact information, by all means, you can scan, or it's on our business card. That gives you links to like different videos, there's a cheat sheet on seller concessions. So depending on the loan type, the down payment, it kind of has all that there, along with my contact info, application links, kind of everything there. And that's on our card as well. For this side of the room, I don't just say good things about me, other people say good things about me, okay? So over the past year and a half, we take really good pride in customer service. Like, I'm the hand holder in our business in the mortgage aspect of it. Last year, ranked in the top 10 with our company. So I like that. All 5-star, 4-star, no 2, 1s, 3s, like, we try. The company itself, so the mortgage firm, okay? We're a big company, nationally recognized. We're not big as in like Rocket Mortgage or Quicken Loans, like we're not that. But what we do, been in business over 28 years. We're not new to the business. Our loan officers, so like myself, we only go with top notch. Like, we're not gonna have 20 originators doing 1 loan a month, okay? And last thing, we're a correspondent lender. So if y'all don't know what that means, that's basically, we do everything in-house, from pre-approvals, which is me, right? To processing with my processor in my office, underwriting, servicing, it's all done in-house, okay? Now, being a correspondent, that also means we can broker out different types of loans. So some of your crazy stuff that we'll touch on, we have the ability to send that to a private investor and have them take it for us, okay? That's a whole side of the business in itself. So quick quals, are any of y'all, have y'all used quick qual before for pre-approvals? What this is, basically anytime we send a pre-approval to a customer, they get a link where they can access their pre-approval letters. So if you're writing an offer at 2 a.m., Cameron is not up at 2 a.m. So what this allows you to do, it's only set to go up to whatever parameters we set for that customer. So they can come in or you can come in and actually print or update a pre-approval letter, okay? So that just streamlines it. By all means, reach out to me. It's 2 minutes for me to pull this up, text you a new pre-approval. But it just gives everybody access. Next thing, everybody has online applications. If you ever have a customer not filling out an application, it takes 15 minutes on your phone. It auto-populates the addresses, the employer contact information. Like, it's easy, okay? Different types of loans. Let's touch on this. I'm gonna run through this quick so we can get to what y'all are really here for. But all of your normal stuff, your conventional, your VA, your FHA, big advocate of VA loans. Go to Texas once a year, re-up a certification, trying to keep us top of mind there. But some of the weirder stuff, so your non-conventional lending. Have any of y'all done the bank statement loans or the DSCR loans to know what those are? So they have grown in popularity through 2023 into 2024. What that's gonna be, those are both programs where, say you have a self-employed buyer who their CPA does a great job. They deduct everything out of their income and show net profits of zero. Yeah. So what we do with the bank statement loans, we say forget about the tax returns. We're gonna get 12 months of bank statements, add up the income coming in on those bank statements and use that in qualifying, okay? The investor cash flow loan, what that is, that's for investment properties. Your typical 25% down, 30-year fixed rate mortgage. We do not look at the borrower's income. We do not look at their debts, their liabilities. So it takes that out of the picture. What we use to qualify, have good credit, 25% down, and some money in the bank, we call that reserves. And as long as the rent, the market rents on that property, offset the note on the house, they qualify, okay? So we use the market rent from an appraisal, or we can show a lease agreement and show that the money coming in on that property is more than the expense of the property, okay? So that's pretty streamlined, very straightforward to do. Then your renovation loans, your construction loans, foreign national, the I-10 loans, all of that. Those are all in our wheelhouse to be able to do. Has anybody heard the family opportunity mortgage? It's a fancy word for a conventional loan, but what it is, there's a little stipulation in conventional guidelines where if you're buying a property or say you have an elderly parent or a disabled child looking to buy a property for them, you can write it as your primary residence, get all those benefits, even though we know you're not physically moving into the property, okay? So there's perks to doing that. Next one for us, you have your pre-approvals. There's really 3 stages in the business these days. You have the pre-qualification letter, which is stated income, doesn't really mean much at the end of the day. You have your pre-approval, which is where we get the documentation from the customer. We review the documentation, put in their qualifying income, and truly qualify them for a pre-approval. And this 3rd step, we've done it with some customers here in the past, and it's picked up steam, especially on the North Shore, where we're seeing many multiple offer situations. But it's a TBD underwrite is what we call it, where we will literally underwrite the customer up front. I send the whole file to my underwriter, she reviews, and she clears the credit, the income, the assets. So that all that's left for that borrower to approve for the loan is the appraisal, title work, and insurance on the property.
Wait, go back. lot of multiple offer situations on the North Shore?
Yes.
gonna say that too.
Yeah, absolutely.
Oh.
Starting, that was really literally starting like the third of the year.
Really?
Mm-hmm.
Huh. We're a little behind, I guess.
And at different price ranges, really, I'd say 300 to 650 price range. So what that does, we can just absolutely leverage that when that customer's putting in an offer on the house. We call the listing agent. And if you've been on the listing side of a deal with us, you know that I'm gonna pick up the phone, I'm gonna call you, let you know they're solid from the financing side of things. We can just leverage that even more when they're fully underwritten, they're ready to go. It can speed up the closing and it takes that concern out from the listing agent or the seller. SnapDocs, everybody does it. Hybrid closings, the customer can e-sign a lot of things prior to closing. I know we all like to be at the table for an hour and a half, but this limits it. You can close 30 minutes, be done. Okay. And the last thing for us, if any of y'all have customers who are trying to decide whether they wait to buy a house or they buy now, right? That's been a big question in the markets, or at least we push it from a marketing standpoint. We can give a real breakdown and analysis. It takes into account real appreciation it's for the zip code, and the cost of that loan amortization, of paying down that loan balance. What it does here, it shows them the true numbers on waiting 6 months, a year, 2 years, 3 years to buy a house with the appreciation. And we ran this one, I want to say this is from the end of last year, St. Charles Parish. They were trying to decide, do they break their lease that ends in June, or do they buy now? Do they break the lease or do they wait? It was costing them $1,600 to break their lease. Well, when we looked at it, the cost for them to wait till June was about $6,500 from a 4% appreciation rate to right over 2% for 6 months and paying down that loan balance. So just getting like the analytical side, trying to take emotions out of those decisions. So really what y'all are all here for, the forecast for 2024, right? What are y'all's expectations coming into the year? I know we're in February already, so we can cheat a little bit, but what's the expectations from the mortgage side of things for y'all?
Rates in the 5s.
5s? God, that would be great. Any others? We're all gonna go off a carry here? Rates in the 5s?
That's what I want.
I keep hearing second quarter is gonna pick up and sort of set the tone.
It's an election year, right? Come on.
It's an election year. So that's our wild card, right? Just like if we were to have another pandemic or anything like that. But here's what we're facing coming into the year. Our real problem in the market, I say we have 3. We have insurance. We all know that that's kind of an issue. I'm gonna put high rates in quotations. You know, high over an average of 30 years, no. But high compared to 3 years ago, yes. And the biggest one from my perspective is negative media, where we're scaring everybody out of buying a house. Whether we're in a bubble, whether the market's gonna crash, I think we've kind of squashed those at this point. But the media's still doing their part, trying to gain followers and put fear in everybody, because fear is what sells. So the opportunity here, we all saw this through 2023. We expect this to continue through 2024. Our opportunity is outlast. Our mindset is, we're gonna keep pushing no matter what, in the whole I've got this mentality. But what the market really did for us in 2023 is it gave us this opportunity. We can grab more market share. That's at an individual base, right? But there's less competition in the market because of the year of 2023 that we had. There's more time on our hands. We all have less activity going on, where we have more time to do those outgoing activities and bring in business. And we really don't have excuses, because the market is the market. If it'll go to the next slide, it'll tell you that. Our market is the market, right? There's nothing we're gonna do today to change that for tomorrow. So from our perspective, it's kind of been a benefit to us to be able to grab that market share. We've stayed in, we've all outlasted everybody sitting in this room, even those coming in new. Like, it's a great opportunity in our market. So the focus coming into the year, visibility, which is what leads to business for all of us, being visible in our markets. Everybody knows Ryan Serhant, right? Guy from New York? No? Oh my God, okay. All right, well then we squash this. So it's the guy with the TV show, slick gray hair. He runs the New York market, runs the LA market. And his preferred lender is part of our coaching group who made a comment at our end of the year wrap up. And I had to put it in here. He said, best known beats best 10 out of 10 times. So what he means by that is like, we can have the best process, and this is me speaking. We can have the best process, we can have the best customer experience, but if we're not the best known in our markets, then we're getting beat out, right? Sure. So for me, the past half decade, 6 years, we've focused on having the best process, being the best knowledge base in our market. We haven't focused on being the best known. So kind of part of the reason I'm here today is staying out in front of everybody. Y'all are doing the same things. The more we get our name out, the more business we attract, right? So that's kind of our focus coming in for the year. So our forecast for the year, this probably says it best. Rates are like the weather. We can predict a hurricane and all we're gonna get is some clouds, or we're gonna say it's sunny today and 10 minutes later it's gonna start raining, right? So our forecast, we're expecting rates are either gonna go higher, they're gonna go lower, or they're gonna stay about the same, okay? How do y'all like that forecast?
It's insightful.
Right? No, so really, before we jump into it, we can all make predictions. I certainly have mine. Kara's is getting into the 5s, so we're pretty close. But until pirates attacking the Red Sea or another pandemic occurs, heaven forbid, all of these forecasts go out the window, right? So how'd y'all like that? How was that forecast? Do I get a tip? Everybody else is doing it. I wanted to do it too. I'm kidding. Let's jump into it. So every expert in 2023 said rates were going to be coming down. We were going to get lower rates in 2023. It was going to boost business. It's going to be great. Did anybody experience that?
No. Not at all.
So we hit our highs around October, right? Flirting 8.5%, depending on the scenario. And rates did come down pretty quick, pretty well over the last 2 months of the year. November and December were great months in the market. So what happens, the Fed is trying to take care of the economy. When they do that, they raise rates to help slow down inflation. They raise their Fed funds rate, right? That's a commercial overnight borrowing rate. They do that trying to cool inflation, and we know that inflation is really what drives mortgage rates. So, kind of what we just said. Here's what the big dogs are predicting coming into the year. You've got Realtor.com was saying 6.5 by the end of the year. You've got another 6% to 6.5 by the spring of 2024. We're getting kind of close to that. NAR, which probably had a very good prediction in the market, 7% in a few months. They said this back in November, and into the 6% by spring of 2024. They were pretty dead on. They have been so far. Mortgage Bankers Association, so that's my group. You know, I pay my dues to them. They're going to be the most optimistic, right? They want us to continue paying our dues, sending in our money. End of 2024, 6.1%, very specific for some reason, and reach 5.5 by the end of 2025, okay? And Fannie Mae, who probably has the best hold on the market, they have all the data, all the real data. 7% in Q1 of 2024, so that would be currently at 7, and by the end of the year, around 6.5, okay? So we said inflation is what drives mortgage rates. This is probably the biggest measure of inflation, CPI, is Consumer Price Index. That gets technical. We're going to get a little technical here, but we'll speed through it. We can see inflation hit highs. It's definitely come back down, right? The Fed wants to see it at 2%. That's their target, right? Well, what we really look at here, you've got CPI, and then you've got what we call the core CPI, the orange there. What the core CPI is, that strips out food and energy prices, which really is what affects us. But that is what the Fed looks at when they're looking at cutting their Fed funds rates. They're watching this core CPI number. So why is core higher than like the headline CPI number? Well, the way the Fed measures this, the shelter cost inside of the CPI report, they do it over, it's a 12-month rolling average. So for the math people in the room, sorry if I'm the only one, a 12-month rolling average. So it's delayed. And we can see that here where shelter costs just hit their peak. That's rents, that's home prices. That just hit its peak and is now on its way back down. But it's still 12-month rolling average. So we're still averaging the past 12 months, not looking at current shelter cost. So what we do, we look at CoreLogic, which is the gold standard of current shelter cost. They're 2.5%, okay? The Fed's not looking at that as they should. They're looking at that 6.7% shelter cost. So there's a big difference there in what the Fed's using in their numbers versus reality with today. So the math behind this, shelter has a 44% weighting in that CPI number. When we do the math, take that into account, there's a lag effect. And that brings real inflation down to about 2.3% if we were to be going off of current month's reports. But we're not, and we're fighting through that with the Fed. But what we can look at with them is the shelter cost coming in through the year and how that's going to affect rates moving forward. So it's a 12-month rolling average. So I've got 12 months up here. You can see the first 3 months of the year, we're replacing December's number, January and February. After that, those numbers are lower. So what we're seeing, this is our time to make up room in the market. December's number already came out, very lackluster, kind of even kill. It didn't move down like we wanted it to, but we still have January's inflation numbers and February's inflation numbers. They come out a month later, so Mardi Gras Day, it's gonna be a big day in the markets where January inflation numbers come out, okay? What, we're 2 weeks away from that?
Less.
Yeah, don't scare me. And then March 12th, we get our third inflation reading for the year. So this is where we see we can make headway with mortgage rates in the market, simply because this has the most weighting in those inflation numbers, and we're replacing these high numbers with the lower numbers that we've been seeing, right? So that means January, February, March, we're expecting good things. The rest of the year is where those numbers get a little harder to replace. So what we focus on here is where inflation is, what the expectation is, and then the Fed meetings that come after each of those inflation readings. So we just wrapped up the Fed meeting yesterday, right? They didn't really say much, but the market reacted well. Not necessarily from inflation numbers, but from the economy in general, jobs coming in lower than expected. We had good moves in the market yesterday. So January 31st, that was a check. Not necessarily for this reason, but we'll take it. We'll take every bit we can. Their next meeting is March 20th, okay? The expectation at that point is that this core inflation reading gets below 2.5%. That would be big. It's not at the Fed's 2% reading, right? But we're getting close. We get under 2.5, the Fed's got to start thinking about making some moves, right? And then look at the May 1st meeting. This is our second big date for the year. May 1st, we're going to have 4 different inflation readings come in. So the May meeting, we actually get 2 inflation readings right before their meeting in May. So this is where the market's expecting the May Fed meeting, they're starting to cut their rates. Because look, we're very close to that 2% reading that they want to see, right? So we expect good things Mardi Gras Day. We expect good things come May. There's a ton of other reports that come out in the meantime, but this gives us a good idea of what we're looking at. This is the probability of Fed rate cuts through the year with each one of their meetings. So we just had the January meeting where we didn't expect a rate cut in the market. We were 2% of people, this is a consulting firm that watches this isn't the Fed. Only 2% of the people predicted a rate cut. So yeah, we're in line with that. The March meeting, we're close. 43% of the people are expecting a rate cut. So it's unlikely at this point that we get a rate cut in March, but we're close to it. May, that prediction jumps up a lot. And look at the rest of the year, okay? So that's what the market is expecting with Fed rate cuts. So what we have here, this is 2023, where sorry, I'm like jumping back and forth trying to address everybody. 2023, this is where we outlasted. This is where the Fed held their rates. We've all felt it, but just the cost of eggs. Even for those who have chickens, I still buy eggs. 2023, we've outlasted. Each dot is a Fed member that actually votes on whether or not they cut rates. So you'll see for 2024, you've got 2 people up here, we need to vote them out, saying 0 rate cuts. You've got 1 person down here saying we're gonna have 150 sets, 1.5% rate cuts. The majority of the Fed members are expecting rate cuts through the year, right? Some are saying 0.5% decrease, some are saying 100%, but that's kind of what we're looking at. But I think the bigger takeaway from this is look at 2024, yeah, we expect rate cuts. 2025, we expect more rate cuts. 2026, we expect more rate cuts. So what does that do? And that's showing the economy strong. It's strengthening as we get back into this. They've cooled it down. They've done what they needed to do. And the trend for the next 3 years is that they continue cutting their Fed funds rate. That has helped inflation. Inflation is what drives mortgage rates. So mortgage rates will tend to follow this, okay? So we've made it this far. Here's what we're looking at coming in 2024. Good news. 2025 only gets better. 2026 only gets better. Good things on the horizon. Now, what we can all watch in the market, you can Google 10-year treasuries. Everybody says mortgage rates tend to follow the 10-year treasury. So this is over the past, since 1990. And what you'll notice here, there's a normal spread between 10-year treasuries, and there's the spread that we have right now. We won't jump into why, other than mortgages that are being written right now, there's no servicing value to it. So we don't make money for servicing a mortgage these days, only because it takes 5 years to make money on that. And the expectation is that those mortgages are going to refinance before that 5-year period where we actually break even on the servicing. So the way that Fannie Mae and Freddie Mac make up for that, they increase their rate. So it increased the spread between these two. So to Kara's point, if we were to look back at a period where 10-year treasuries are right below 4%, 2009, 2010, following a recession, the 10-year treasuries were right under 4%. Mortgage rates were high 4s, low 5s. So that's the potential that we have in the market. Do I think we're gonna get there this year? No, absolutely not. But that gives us a forecast of where a normal market would be, okay? So that's our potential in the market. Now this is mortgage-backed securities. If you follow us, shameless plug, okay? If you follow us on Instagram or Facebook or we're on TikTok or whatever all it is these days. We post this pretty regular of, hey, here's what we're looking at for the week. This is mortgage-backed securities. So it's an inverse relationship. As this goes up, interest rates go down. So we like seeing this go up. This is October when we hit our peak. The moves in the market at the end of the year were great. 8.5. We made it down to 6.5 in some cases, high 6s even. And then look at January. It's been pretty steady. It took a little bit of a wrong direction through the whole month until I didn't post this from yesterday. This is from last week. We've seen this jump back up just this week. We've seen the jump back up. We're sitting right under that 102 level. So right at best rates of what we've seen over the past 2 years, okay? So if you ever want to have an idea of exactly what the market's doing, that's mortgage-backed securities. So that's, we write 100 loans, we package all those together and sell that to the government. Sorry for my voice. That's what a mortgage-backed security is. So some of the things we also want to touch on, through 2023, we kept hearing, well, is a recession coming? Is a recession here? Now we're saying, oh, we're going to have a soft landing or no recession at all. We don't know technically if the government's going to say we were in a recession until about 2 years after it happens. So we'll get that data down the road. But what we do know, credit card balances, all-time highs, okay? Personal savings rates. We saw the spike, COVID, that stimulus money is what we're looking at there. Savings accounts went up, they were great. We're already back down below where we were prior to COVID, okay? This is national, this is all the numbers inside of this. So what I can speak to here, credit card balances. We're still doing refinances every single month. These people had a 3%, a 4% rate. They're refinancing into 6.5% rates, 7% rates in some cases. And it's still making sense for them to do that because they've got this bad debt. They're paying 20% on this credit card with a $15,000, $20,000 balance, or the auto loans at 9%, or the personal loans. The bad debts is what we're getting rid of. Their total monthly payments going out, so their house, their credit cards. By the time they refinance, this is an extreme example, but we had a veteran come in, he's saving $1,988 a month by refinancing into is like a 6.5% rate, getting rid of that bad debt. $1,000 a month makes a huge difference, especially for them. It was great, they loved it. They said, you know, so what with that 3% rate? 6.5 is great, we're saving $1,000 a month. Okay? So, a threat has been detected on my computer. Let's touch on affordability. That's a big excuse. I'm going to call it an excuse in the market. There's some validity to it. But in 2021, rates below 3%, that house, you were getting a $240,000 mortgage. The payment on that was $1,000. That was great, good times. Now, that loan you're getting for the same house, $280,000, compared to what it was in 2021, your payment went up $800. That's a big chunk, right? We can all agree there. It's 80% increase in your monthly payment. A $4,000 a month income qualified you for this in 2021. So we need income to increase to the point where this gets affordable, right? So the way that math works, a $4,000 income, you only need a 20% increase in income to be able to afford that same house. You don't need an 80% increase, only 20, right? So ADP, it's a big payroll company in the US. Their numbers showing income has risen by 15% since 2021. So we're not at 20%, we're close, we're getting there. But their prediction for 2024 is a 5% increase in income, okay? So that would mean we're getting to this point where the numbers now make sense and it's affordable for people to buy houses. Does that make sense? So that's their expectation coming in for the year. Just to touch on the affordability, I know that's a big point in our market. Now for housing itself, are y'all familiar with household formations, what that means? So think of like a kid graduating college, they're coming out, they're forming a new house, whether they're deciding to rent a new house or they're going out buying their first house. Divorces is another example. A couple splits and now they need two houses, not one. Those are household formations. Completions are, think of new construction, new houses coming on the market. You can see formations, new people needing houses has grown every year, and new houses coming on the market is not keeping up, right? So think of people were expecting home prices to fall drastically. Well, across the nation, inventory is not there, right? The number of houses coming on the market isn't keeping up with formations. That's that supply and demand, keeping these home prices where they are. Something for us to think about coming into the year. Now, what I can't account for here, the pent-up demand in the market from last year. How many of us, I'll raise my hand, had clients come in, start shopping for a house, full pre-approval, and back out? Say, now's not the time, I'm just gonna wait. We have that pent-up demand in the market. Those buyers, we're still staying in touch with them. I hope y'all are too. January 2nd and January 3rd, the number of them that called back saying, Cameron, I'm gonna buy by the spring. I had one individual who said, I wanna buy before Mardi Gras. He actually hasn't yet. But
He's got a week.
he put a lowball offer in and then I think got discouraged again. But that pent-up demand should be coming back. Rates have come down, right, from where they were shopping middle of last year. And the other thing we can't really account for yet is the refinance business for the mortgage market. I know that doesn't really affect y'all as much, but what that does affect is that servicing value on mortgages, where we can shrink that spread and get more reasonable rates in the market quicker. By the way, if you have somebody looking to refinance, by all means, like we do refinances. I get asked that question and it blows me away. But yes, we can help with a refinance, okay? So, housing for 2024. The expectation, lower inflation. We're seeing that recession-like feel, similar to 2023. Incomes continuing to increase through the year, helping with that affordability. Rents still staying expensive. Do we agree there? And a big takeaway here, the numbers work for those buyers locked in at 3% or 2.5%. Rates get to that 6% range. The numbers make sense for them to be able to have that move-up purchase that we call those move-up buyers. So 6% would be a great threshold for us to get there. So our expectation on housing, low single-digit appreciation, really your 3 to 5% appreciation rate in our market. It's kind of standard with the national average, 4%. Nothing crazy for this year. And we expect transactions to pick up 15, 20% from 2023, okay? Now for the mortgage forecast, same thing. Lower inflation, we like that, we love that. Increasing in that mortgage servicing value helps bring those rates down quicker. That recession-like feel is gonna stay around, and Fed rate cuts, they're coming. So our expectation, and we can cheat a little bit here, right? We're a month in. 30-year fixed rates in that mid-6 range, 6.375 to 6.625 during the first half of the year. Now what we need to say here, VA loans, FHA loans, we're seeing those in the low 6s already. Your conventional loans, we're seeing those 6.5 to 7. And last week we had, it was 2 conventional loans locked in the same day. One was 6.375 and one was 7.125, okay? So there's a big difference between scenarios. That was down payment, that was credit, so that all plays into it. So don't take this as every mortgage is gonna be 6.5%. Your government loans are normally lower rate, but the conventional market has that big spread depending on the actual scenario, okay? So
I saw something today that said for a 15-year, it was at 5.9
I believe that.
for a 15.
Yeah, 30 years are not gonna be that far from it. If you've got a lot of equity, good credit,
Yeah.
gonna be pretty close. The 15-year, the advantage there has shrunk over the past couple of years.
Yeah, definitely.
So, and then the 10-year treasury close to 3.5%. Remember, that's what we like to see. Mortgage rates tend to follow that. So, I've got 2 questions for y'all, but what questions y'all have for me based off of that? Y'all gonna make it easy? Yeah?
You're supposed to encourage my hopefulness.
So, well, what we've seen in the market is we're very, very close to that mid-6 range already. March, so the February numbers, March numbers, that should only help. That's bringing us closer. We're predicting close to that 6.5 for the first half of the year.
Right.
We're almost already there. So that means the next 2 months, we can make up more ground. End of the year, yeah, you're gonna see some 5s in front of those rates. I do think that's the expectation. I wouldn't have said that a month ago, but where we are today, yeah. There will be some cases over the next month where you're gonna see an FHA buyer or a VA buyer with a 5.9 or a 5.875. That's gonna happen probably here very soon. If not, I haven't priced one out today to know. But we're very close to that point now. Your conventional market, kind of what everybody focuses on, you're gonna be closer, really 6.5, 6.65, 6.75 in the markets if I were to pull rates today. Okay? So yeah, I mean, I do feel like the market can make it to a 5.8, 5.9 by the end of the year at this point. I think the fine print behind that was mid-6s for the first half of the year and then continue to come down through the rest of the year. And that would line up pretty well. So my 2 questions for y'all. Who has listings coming on the market?
I listed one yesterday.
This morning.
Where?
Mine's in Gentilly,
Gentilly, okay. Price range?
175.
Okay. Let's get together after. Yours?
Oh, mine's right over there,
Uh,
half a block from, we're at 650.
Oh, yeah, okay, all right.
Hers is more exciting.
I have buyers looking. I don't think I have a buyer looking. Okay, and then what about buyers coming on the market? Who has talked to somebody saying, coming in, starting the new year, they're buying a house in 2024?
I have one, she's working on her credit, but.
Yeah, does she have somebody helping her work on credit? Or at least talk through it?
I'm kinda helping her with it a little bit.
Okay.
Yeah.
So we can do soft credit pulls,
No, I didn't know that.
and that way we can get the picture, not have that hard inquiry, and help put together exactly the best way to get that credit score up quickly.
Okay.
So that's definitely a benefit there.
Yeah, that's awesome, okay.
If they're not working with a lender, by all means,
Okay.
I'm here.
Okay.
Cool. Anything else? Yeah. What do y'all think?
Sounds good.
It's gonna be a better
Good.
year this year.
Better, absolutely.
Yeah.
All right. Well, y'all are easy. Not too technical, huh?
No, I enjoyed it.
Okay. So inflation coming down. Seriously, if y'all follow us or watch just inflation in general, as that's coming down, mortgage rates are coming down. Okay? The Fed makes one comment that they're ready to cut rates, the market's gonna have a big jump.
Yeah.
So as soon as they incline that they're gonna do something with their Fed funds rate, the market's gonna jump on it. Okay? Cool. Well, that's it. We've got 8 minutes to spare. No. Yeah, what's up?
I'm sorry.
I thought we were done.
Not related to anything we just talked about.
Yeah.
But I have someone that's asking me about getting a hard loan or a bridge loan, and I need to know how to talk to them about it.
It's actually a good question.
Hard money loans, if you have somebody that does it, please send them my contact. Please send me their contact.
Right.
We get that question regularly. I don't have anywhere to point those people.
Yeah.
Rates on that, it's going to depend on the lender. You're talking teens, 20. I don't know if I'd say 20.
I think the last one I saw was like 17.
Yeah, yeah.
Right. So
Bridge
Karen
loan?
and I talked about it a little bit shortly, and
Yeah.
I was like, I just need to find out what they're trying to accomplish to see if I can't help them in a better way, maybe.
What I find is that if somebody comes in and says, I need a hard money loan, they've never talked with a mortgage lender to really know if they have a valid option other than that. That's a last resort, in my mind.
He's just moved here from New York, and
Okay.
he was trying to retire his contracting business.
Okay.
Bought a house, wants to fix it up, but now that he's doing that, he needs a little extra money coming through. So he was like, I want to do like a bridge loan or a hard loan, and then maybe just pick up some contracting on the side a little bit to flesh it
Yeah.
out. But I'm thinking maybe if he could get a renovation loan.
A renovation loan that'd be a
for the
valid
house
option
that he
there.
just bought.
A second mortgage, if he has, depending on how much equity he has in it,
Yeah.
like a home equity line of credit, that's going to be a heck of a lot better than a hard money loan.
Yeah.
Granted, he can qualify for it, right?
Yeah.
With if he's completely stopped his business, where's the qualifying income? But a renovation loan, a HELOC, we look at both of those kind of side by side. Bridge loans are going to be more like, think of your predicated offers, where you're taking equity from the house you're about to sell. It's a 12-month loan, and as soon as you sell that house, you're paying off that bridge loan. Okay? So if you have somebody who needs to sell their house before they buy the next, that's where a bridge loan can come in. You take the equity out of that house now
Instead
without
of doing
selling it.
contingency and
Yeah.
offer?
Exactly.
Okay.
If I don't have bridge loans on that list, I should. Like,
Okay.
they've got to have a lot of equity in the house to do it. That's normally the biggest kicker. That's really what that's used for. So
I might give him your number.
tell him to call me. It's just a conversation.
Yeah.
If he doesn't have any other options, hard money, and just pay it off as quick as possible. Yeah. Yeah. But we don't really touch on that market much.
Yeah.
I'll get asked it every now and then, and just I don't know what to tell people there.
Say
Like,
good.
there's no contact. Yeah, yeah. It's not a bank. It's not like
Yeah.
who's gonna offer it. So if you find somebody, let me know.
Okay.
Cool. Anything else?
Thank you.
Y'all are all so quiet.
Thank you so much.
Yeah. Y'all eat up. There is definitely more left.